find the link to AI trading strategy prompts in the description and pinned in comments below. Almost every beginner tries this one thing in crypto and it ruins their returns. What you think of as timing the market is actually a trap, and I'll show you the three invisible mistakes that make it fail, plus one counterintuitive strategy that actually works. In the next 30 minutes, you will learn why timing fails. You will hear real stories of people who lost because of it. You will see the math most creators never show, and you will get a practical low stress approach you can start today. Stick around, the third mistake will shock you. I'll reveal a simple rule that prevents it. If you want clear, no fluff crypto education for beginners, hit subscribe. I post weekly breakdowns that help you avoid expensive mistakes without the hype. When people say time the market, they usually mean one thing: buy low, sell high. But what that phrase hides is real behavior that ruins returns. Imagine trying to catch a falling ball while blindfolded. That's timing. The market moves on news, emotions, and cycles you can't predict consistently. I'll show three simple examples: a newbie who bought one on hype, a trader who tried to scalp every dip, and an investor who waited for the bottom for months. Ronan from Phoenix bought during a viral pump at $45,000 per coin. 6 months later, it was $12,000. He sold in panic. He didn't lose because crypto failed. He lost because he tried to time it. There's fear in that story. Fear that you missed out, and fear that you will buy again and lose. That fear drives the worst decisions, but that's only half the problem. In the next section, we'll break down the math that makes timing so dangerous, and it's not what you expect. Here's a surprising truth: even if you are right 60% of the time, timing can still make you worse off. Why? Because losses compound differently than gains. If you lose 50%, you need 100% to recover. So, one big miss can wipe out small wins. I'll show you two quick scenarios: a buy and holds investor versus an active timer who's right 60% of time but hit by big drawdowns. Lose 50% and you need double. Lose 30%, you need almost half again. That's the gut punch. You could be winning small trades, then one swing wipes you out and leaves you demoralized. But there's another invisible factor: behavioral bias, that makes timing worse. That's the one almost nobody teaches. Most people blame the market, but three invisible mistakes are the real culprits. The third one is the most destructive. You buy when markets spike and sell in panic. That's fear of missing out, FOMO, and fear of loss, FOL. So example, buying at the top after a 200% run. That feeling of fear of missing out is engineered by social proof and hype. People treat crypto like a casino when they use borrowed money or put too much of their portfolio in one coin. One margin call and you are wiped out. That's terror, not strategy. Waiting for the perfect bottom is passive timing. You keep cash on the sidelines, convinced the perfect entry is days away. Months pass, opportunity costs pile up. Meanwhile, prices quietly trend higher. Regret builds silently. It's a slow, bitter feeling. If these three mistakes sound familiar, good, because in the next section I'll show the simple rule that prevents them all. Here's the twist nobody tells you: the most successful retail investors don't try to time markets at all. They design for randomness. They build systems that profit whether the market spikes or falls. So, what actually works? One simple rule prevents all three mistakes and keeps you in the game long enough to win. Rule: use a disciplined entry system plus position sizing plus automatic rebalancing. In plain terms, dollar cost averaging. Never risk more than a small percent per trade and rebalance periodically to take profits and lock gains. DCA means buy fixed amounts on schedule. Position sizing means risk 1 to 2% per trade. Rebalancing means take profits and redeploy. Think of it like steady farming versus gambling. You plant seed every week rather than waiting for a perfect storm. This removes the emotional roller coaster. You lose the panic, you avoid leverage, and you stop waiting forever. That's calm, confident investing. Next, I'll show real numbers and a simple plan you can implement in under 30 minutes. No fluff. Here's a 4-step plan you can implement in 30 minutes. Step 1, allocate. Decide crypto percent of net worth, small and conservative. Step 2, automate. Set DCA schedule weekly or bi-weekly buys. Step 3, risk control. Never use more than 1 to 2% per position. Avoid leverage. Step 4, rebalance and review. Monthly, take partial profits, rebalance. This plan replaces anxiety with routine. It's boring by design and boring wins. But there's a final important point many skip: how to handle big market crashes emotionally and practically. The biggest test of any system is when markets crash. Here's how the rule saves you. During crashes, DCA increases your average position cost advantageously. Rebalancing forces profit taking when markets exuberate and buying when fear is high. Use a written plan with exact thresholds to avoid panic selling. Alvin's calm DCA brought more coins during a 40% crash. 3 years later, his return tripled. Instead of terror, you get option like exposure. You buy quality at a discount and watch time do the heavy lifting. One last bit separates winners from the rest, and it's simple. We write your plan now. If you want more straight to the point crypto strategies that help beginners avoid costly mistakes, subscribe now and turn on the notifications. We break down strategies step by step, no hype, just what works. Before you make any trade, watch the next video where we discuss inflation, hedging, and asset protection. It could save you from one of the biggest beginner mistakes. Click here. Timing: the market feels tempting, but it's a mental trap and a math problem. Build process, control risk, and let time and discipline work for you.